If you feel like you're spinning on the never-ending hamster wheel of renting, know that you are not alone. You may be feeling pigeonholed into renting because you don't know if you're financially ready to buy a home. Yet housing prices, groceries, and just the general cost of living keeps getting higher, which in turn makes you feel as though you're never quite getting ahead enough and that the possibility of homeownership is slipping through your grasp. Fortunately, the future may not be as doom and gloom as these common beliefs have you thinking. Let's get into some of the common home buying hurdles many feel they're facing today and hopefully debunk them. Perhaps one of the most perceived barriers to homeownership is the dreaded down payment. Because as we know, with the cost of living being higher, that often results in our savings taking a back seat. Fortunately, long gone are the days where homebuyers were required to put 20% down on a home. Loan programs, like some VA loans, may get you into a home for as little as 0% down, while others, like some FHA loans, may require as little as 3.5% down. Plus, there are numerous loan programs and down payment assistance opportunities out there built specifically for first-time homebuyers, which may give you just the wedge you need to get your foot in the door to homeownership. In addition, it's worth noting that you may also be able to source your down payment funds from places other than just your bank account, like by borrowing from your 401k or even using gift funds from qualifying family members, as long as you provide your lender with the necessary documentation to prove the funds were indeed a gift, not a loan. With 42.7 million college graduates carrying federal student loan debt today, the average federal student loan balance sits just north of $38,000. So as you can imagine, that's understandable why so many Americans may think that until their student debt is fully paid off, they're stuck on the sidelines of homeownership. Fortunately, that is not the case. Let's look at an example. Say you graduate with $60,000 of student loan debt and start off in your career earning $60,000 a year. At face value, you may assume that your debt-to-income ratio is 1-to-1 because you earn the same amount as you owe. Some good news here. That is not how lenders calculate DTI. Let's dig into this hypothetical example a bit further. Say your $60,000 worth of student loan debt was financed at a fixed rate of 4.15% over a 20-year term, resulting in a monthly payment of $500. Then add on a $1,000 a month rent payment plus a $300 a month car payment, resulting in your total monthly debt being $1,800. With your $60,000 salary, that puts you at a gross monthly income of $5,000. So to calculate your DTI, we'll take your total monthly debt, $1,800, and divide that by your monthly pre-tax income, $5,000, bringing your debt-to-income ratio to 36%. Typically, a DTI of 36% or lower is considered by lenders to be a manageable amount, which is ideal when trying to qualify for a loan. So in our hypothetical example, this is actually great news, as homeownership may be within reach after all. And if your DTI is higher than 36%, you absolutely could still qualify. So be sure to talk to your lender to discuss your unique financial situation and loan options, because DTI is just one of the many variables lenders consider when evaluating your risk, and each loan program has different debt-to-income ratio requirements. So rest assured that when it comes to obtaining a mortgage, it's not about whether or not you have debt, but rather the balance between your income and debts and then how you're managing it. With all that said, we hope you feel just a bit more encouraged in the fact that regardless of what misconceptions are out there today, homeownership may actually be more attainable than you think. For any financing questions and to discover your options, reach out to a licensed Pulte mortgage financing advisor today. We're here to help.